So on today's series, I'm going to break down your lot size application and leverage, right? So whatever capital you're starting with in trading, when you register on a broker account, you'll have to choose your leverage, and you got to understand how to apply your lot size effectively with your leverage so you don't get margin call, you don't get into margin trouble. And as your account grows, as your capital grows, you need to stay within a certain parameter of your lot size, nice, and don't ever go way above your head when it comes to your lot size just because of your leverage. Because if price is to go against you and you have to go into a little drawdown, nice, a little percentage decrease, and you max out, your margin will also be affected, and that will definitely put you into margin trouble. And the broker will close out your biggest trade that is in the biggest loss, and that will happen automatically. Nice, so you don't even need to hit your stop loss. The broker will automatically close that position, right, to protect themselves. And they are lending you a loan when you're actually using leverage, right? It's like the broker giving you a loan to trade on a much higher lot size than your account could even handle. Yeah. So if it's going against you, he's going to close it out before it wipes out all your money. If it goes in your direction, well, then you make much more than you can make with even your small capital. So I'm going to teach you guys how to apply yourself effectively, nice, with your lot size and your leverage, so you don't ever blow up. You stay intact all the time. So when it comes to leverage, we do 1 to 2,000 max, nice, 1 to 1,000, 1 to 500 minimum. We can't go no lower than this because you will not be able to build a portfolio and you won't be able to hold much drawdown in any position. We want to be able to hold drawdowns. When it do occur, it will occur. It's inevitable. You can't get the market to go in your direction all the time immediately. Nice. So we need to leave breathing room for price to fluctuate, and we need to hold a little drawdown sometimes. That is part of the business. So 1 to 500 min, 1 to 2,000 max. There are some unregulated brokers that might allow you to go more than 1 to 2,000. 1 to 3,000, 1 to 4,000, 1 to 5,000. You don't need to go all there. Here to here is just good for what we are looking for to achieve, what we are looking to achieve. We are stacking the odds in our favor because we can now have 2 long, 2 shorts, 3 long, 3 shorts, whole drawdown, and all of them still not get put into margin trouble, still not get margin call. Nice. Any lower than this, you cannot have multiple trades on at the same time, and you cannot go into a drawdown. It's going to close out your positions. So we can't do the 1 to 300 or the 1 to 200 or the 1 to 100. You can do the 1 to 500, the 1 to 1,000, the 1 to 2,000, and anything above you could do too. But this is what the brokers normally offer, 1 to 2,000. So we get to build portfolios with this. We get the long short approach with this. So if you're starting with $100, nice, you can, when you have a 1, it's like you have $1,000 capital. If you have $1,000 capital, nice, you can trade like if you got 10,000, which means you could actually execute a lot size that you can execute with $10,000, even though you only have $1,000. You can execute mini lots. Nice, you can even execute a standard lot too. But 10 pips against you, and that's it. Yeah, 10 pips against you. Boom, boom, boom. That's it. So you can even execute a standard on some pairs. Will allow you to execute a standard. A low pip count pair, yeah, you'll actually be able to execute a standard. But if your price only go against it, your whole account is gone. So you are able to place certain lot sizes on your capital. And this is the thing. Not because you have this type of leverage, mean you're going to raise your lot size ridiculously because you just want to make plenty money, you think the market is going to go straight in your direction when you click, and you're not out here to guess and gamble and to see if the market will go immediately in your direction. You can have a direction. It's not about perfect entry, but it's about perfect direction. The market could fluctuate. You could go in a little percentage, increase a little drawdown, and then the market eventually goes in your direction and you become profitable at the end. But if you just keep trying to shoot out there, your whole account just to see if you'll get it right, to go in your direction to make some money, you can just find you just throwing money in a hole. Right? So this is very important. You're not going out there and trade with ridiculous lot sizes just because you can execute that type of lot size on your capital. Now, you will see these lot sizes, basic education that people learn, coming up in the game. Nice, and 0.01. So these are the lot sizes that you will see people using. This here is $10 per pip. That's a standard lot. Standard. This is what everybody loves to trade. $10 per pip. Yeah, they love standards. Everybody want to reach here to trade to make plenty money. Nice. Here, this is a mini lot. This is $1. And this is 10 cents. That's 10 cents dollars. So, this is the lot size that you are accustomed using. So when we look at the application, when it comes to leverage and lot sizes, we need to be very, very, very strategic in how we are using our leverage, the amount of money that we have in our account, and the lot size that we are using. So I can have $100 capital. I can trade on a 0.01, but I could also trade on a 0.02. I could also trade on a 0.03. I could also trade on a 0.04 without going way overhead or risking too much. Because it's all about the lot size or where my stop loss is. So with $100, I can comfortably trade on a 0.02. I can have a 50 pip stop. Nice. And I can only spend $10 there out of my 100. I still have 90. I still have $90. So I do not need to use 0.01 for every 100. I do not need to use 0.01 for every 100. Now that's what you will learn in the basic foundation education. 0.01 for every 100. So when you go up to 200, you're using 0.02. When you go up to 300, you're using 0.03. When you go up to 400, you're using 0.04. And that's how people will try to scale up their lot size as their account scale up. But I could even trade on a 0.04 right here with $100 and still only use, let's say, $15 or $20 for my 100. According is all about the pip, how much pips my stop loss is, multiplied by 40 cents or 50 cents or 30 cents. And my net spent, my net exposure could amount to $15, $20. So I'm not just focusing on my capital or my lot size, but my net spent in dollar cost. Because if I'm using $15, I got let me say a 30 pip stop. No problem. I only have $15 exposed. I have no problem with that. Yeah? I have no problem with that at all. I could risk that. But my returns will be much bigger because I'm using a 0.04. I still wouldn't blow up my trading account if anything goes wrong because I only have a net spend of $15 exposed. But I'm trading on a 0.04. And I will not get into margin trouble I would not blow my entire account if anything goes wrong, because it's all about the dollar cost that I'm actually exposing. Nice? And I'm sharing this with you guys because I want you guys to understand this. So most people think for every $1,000 they need to use a 0.10. I could use a 0.20 with 1,000 and still expose myself to only $50, only $75, only $100. Nice? Most people think with $100 they only can use that. Most people think with $10,000 they use a standard lot. And as their account go to 20,000, 2 standard lot, 30,000, 3 standard lot, 40,000, 4 standard lot, 50,000, 5 standard lot, 100,000, 10 standard lot. Now, understand this. You can have $100,000 trading account and still be using only 5 lots. Never exposing yourself to give the markets more than you can take from them from any one given time. So you do not need to raise your lot size to every time your account grows at 10 units in value. So if you go from 10,000 to 20,000 to 30,000 to 40,000 to 50,000 to 60,000, you do not need to keep raising your lot size up. Because the higher you raise your lot size every time your account go up, remember, it's more exposure, more exposure, more exposure. You can keep catching your 1,000 pip increment move cycles or your 500 pip increment move cycles and your 5 lot or even your 1 standard lot. So you can have $30,000 in your trading account and still only use $10 per pip. And every quarter, every cycle, you're looking at, a 1,000 pip increment move cycle, right? And you're measuring first level 500, second level 500, third level 500. So on the first level, you catch your first level, you make $5,000 US. Second level, you catch that too, you make another $5,000 US. Third level, you catch that too, you make another $5,000. So you made $15,000 there. That is now added to your total capital without even exposing yourself too much. And you're just raking this in, accumulating, compounding, accumulating, compounding. And if anything goes wrong here, your dollar cost, upfront cost, is still low, you still limit your risk, and it's not blowing you up to lose, your capital that you have. So you can still remain on 1 standard lot, even with a $100,000 account, and still be adding $10,000, $15,000, $20,000 when you catch cycles. And this moving from 120 to 130 to 140 to 150, and you don't need to be raising your lot size up every time you go up. Because every time you raise your lot size up, that's why you will see my account, I will not trade on 100 lots. I will not trade on 50 lots. The most I've put on ever since my whole trading career is 25 lots. And my account is big, my account is decent, but I don't need to go and be shooting 100 lot trades out there. Because if I have a 50 pip stop, 100 pip stop, 75 pip stop, 20 pip stop, 100 lots by 20 pips is a lot of money. Yeah? I don't want to be exposing myself to that type of risk. Period. Doesn't matter how large my account is. I will stay on 5 lots. I will stay on 10 lots. I will stay around that area there and keep catching these cycles, keep catching these levels, and just keep growing this. Boom, boom, boom. And do not keep raising this. All I have to do is have a good exposure and just consistently catch them cycles and them levels. 500 pips by 500 pips by 500 pips. ADR times 3. Yeah, ADR times 3. And I manage my lot size and keep my lot size right there. And every quarter, 30, 40,000, 60,000, 80,000, 20,000. Wow, I play. And I just keep adding. When you watch it, it's 300,000, 400,000, 500,000 you're making. Nice? Ride it incrementally, compounding within the quarters. So understand this about your lot size and your leverage. Even though it will allow you to play certain lot sizes on your capital, you still do not have to expose yourself so much to the market. And it's all about the dollar cost. So you don't have to trade at 0.01 for every $100. You don't have to trade at 0.10 for every $1,000. You don't have to use a 1.00 standard lot for every $10,000. You can actually use higher lot sizes between 0.1 to 0.5 on $100 and still only use a net spend of 20 or 25 or 10 or 15 on a position. So your lot size can be between 0.01 to 0.05. You're not exposing yourself to blow your whole $100 account. Nice, you could still, wherever your stop loss is, the distance between your stop loss and your entry, nice, with a lot size between 0.01 to 0.05, could still land between $20 exposure, $25 exposure, $30 exposure, whatever. You can accept that risk and you will never blow your entire trading account. And you don't have to trade on a 0.01. So your returns become bigger because you're using a bigger lot size, but still not affecting your margin, still not over leveraging, and still not exposing yourself to lose the entire trading account. Here, you can use between a 0.10 to a 0.50, even with a $1,000 account. So you can use it at $1 per pip to $5 per pip and still expose yourself to $100, nice, or $200 or $300 on a position out of your actual your $1,000, and you can never lose this entire. You know what exposure you have, whether it's 150, 100, 200, 300. You have 700 remaining lockdown, and you cannot lose that money. You cannot lose the entire trading account. Nice, and you won't be affecting your margin. You can still hold drawdown. You wouldn't be over leveraging or nothing like that. So understand the basic that you learn about lot sizes is not how we really apply it in real life in trading. Nice, and this here you can use between a 1 point to a 5.0. So you can use $10 per pip up to $50 per pip, but you're gonna be exposing yourself to $500. Nice, you could expose yourself to $1,000 out of your 10,000. Nice, you could expose yourself to 1,500 out of your 10,000 and still not blow this. Still have room for fluctuation. Nice, still not over leveraging, and still it wouldn't affect your margin. Nice, for you to get any margin call or anything like that. Yeah, so you have your lot size power, your leverage power of your 1 to 2,000, right, or 1 to 1,000. So you got your purchasing power there. You can still execute these type of lot sizes. You can still expose yourself. You know the dollar cost up front, and you're not going way out of your bounds. And even if you're trading on a $100,000 lot size, a trading account, you can still use one standard lot only. And just incrementally catch your 1,000 pip increment moves that the cycles is moving, and you're raking in $10,000 within a quarter. Sometimes you catch 2-3 cycles within a quarter. Nice, and that adding up to this and turning it into 130,000, 140,000, 150,000. And anytime quarter the market doesn't play out, because you're not going to win all your trades or you're not going to profit all the time, it still doesn't damage you or put you in no significant loss or blown account or anything like that. and you have a framework of a portfolio, so you don't need to win more trades and lose trades to make money. You could actually lose more, win less, still make money. Yeah, and you do not need a high win rate, and you do not need to win more trades because the formula is meant to make money. So this is the key when it comes to lot size application. It's all about accumulating and compounding incrementally on the cycles and the levels with the amount of pips that a cycle does run, and you just limit yourself, keep yourself limited right there, and you still catching thousands of dollars you're making, thousands of pips, and you just keep growing this right there, and you're never exposing yourself for the market to take more from you than you can ever take that you can ever take from them at any one given time. So I hope you guys learned something here, get some value from this. See you guys on the next one. Let's kill it in financial markets 2026.